So as much as I like writing covered calls, it's really starting to piss me off. And here's the reason why. So Snapchat today up 22%, reaching 8.59. Now, I bought the stock at 5.85, I believe. So let's say I had just bought the stock without selling covered calls on it. And let's say I kept it all this time. Usually I don't keep it for this long, but let's say I did. So I'd be up right now, 8.59 divided by 5.85. I'd be up 46%. Now, of course, knowing myself, I probably would have sold it earlier, maybe at around 7. I probably would have sold it at around 7. So I would have made 20%. So that's usually what I do when I swing trade is I'll just buy something that I have confidence in, just buy it relatively low, and then just wait a little bit and sell it a little bit higher, either 10 or 20% gain. But because I wanted to try covered calls, I sold the 2-year expiry call option on this on Snapchat at a strike price of $7. So when I bought it at 5.85, I immediately sold the $7 strike call option, and I collected, I believe, $380 about. And I think I have 200 shares of Snapchat when I bought it at 5.85. That's funny. Look, 1-year target is 7.63. So the 1-year target of Snapchat is actually lower than its current market price. Anyways, so I collected about $380 on a $200 investment. So 200 shares times 5.85, 1170, and I collected around $380. So that was about 32%, but in 2 years. So the $380 covers me for 2 years. So divided by 2, that's 16% or 15% per year just from the call premium. But I also sold it at the $7 strike price. So come 2 years, I think it was January 2021 that it's going to expire. I would also sell I would also sell my shares, or they would get called away at $7 if Snapchat is trading above $7 come January 2021. So most likely it will be. So I would make an extra 7 divided by 5.85, which was we calculated earlier, 19% or 20%. So I'd make it an extra 20% from selling the shares. Now, initially I did this because I thought that as long as Snapchat goes above $7 anytime between now and January 2021, then my shares would get called away. That's what I thought initially would happen, and that was my plan. But apparently it only gets called away at expiry date, which is in 2 years. So this was a bad trade, but it's a learning experience at the same time. I'm still profitable, but definitely not as profitable as I could have been. I'm stuck holding something for 2 years, and it doesn't even pay dividends, so I've got no benefit of holding it for 2 years. Only benefit is I already collected 33% upfront. And in 2 years, when I sell it or when it gets called away, I'll gain 20% profit. But let's say I didn't do any of that, I'd be better off just buying and selling the stock, making 40% in 3 or 4 months instead of 50% in 2 years. So that's one of the downsides of covered calls, is definitely making you miss out on potential capital gains, potential upsides. But of course, not every stock you buy has the potential to go up like crazy. So you'll probably make more money from selling covered calls on a regular basis than just keeping the stocks, hoping that they will shoot up one day. So Intel was another stock that I sold covered calls on. I bought it at 46 and I sold the 48 strike price. So Intel, I sold the 48 strike price and I collected 75 cents for it per share. And look at that. Right now it's trading at $2.32. The 48 strike price, of course, because the stock was trading at 50. So here's another stock that if I did not sell covered calls on, so 50 divided by 46, I'd be already up 9% in, I think I bought it in 2 weeks ago, or even less than 2 weeks ago. So it would have been up 9% in 2 weeks, but now I have to keep it a little bit longer until February 22nd, and the max I'll make is $2.75 divided by 46. So the max I'll make is 6% in 1 month. While if I had just kept the shares and not written covered calls against them, I would have made 9% in half the time. But of course, if my strategy is just to buy stocks every month and write call options or write covered calls against them every month, even if my shares get taken away while my money becomes available, I can do the same thing the following month. If I'm making 4 or 5 or 6% every month, that's very good, of course. But it might be hard to consistently find stocks to buy, because at the end of the day, you still own 100 shares of the underlying stock. So I have to be comfortable owning 100 shares of Intel at 46, which I was, and that's why I bought it, and then I immediately sold covered calls against them. But what if Intel drops to 40? Since I bought it at 46, I don't want to sell it a call option at 42 or 44. I want to stay close to the price that I bought it at, in case, the rare case that it shoots up past the strike price that I choose. For example, if Intel drops to 40, for me to sell a decent call option, I would need to choose a strike price that's near 40. So let's say 42 or 44. If I do that, even if Intel is trading at 40, it could happen, and it could trade above 46 at expiry date. So if that happens, or even above 44. So if that happens, then my shares get called away at 44, but I bought the stock at 46. So that's not going to be good for me, because I'm going to lose $2 per share on the stock. And in fact, that's what's happening with me right now with United States Steel. I bought it at 21.81. It's trading right now at 23 point something. Yeah, so it's trading at 23.17. I bought it at 21.81, and I sold a call option the first month, and then the second month I sold it at 20.5 because the stock dropped. So I got greedy. I wanted a higher call premium. I sold it at 138, so I chose the 20.5 strike price, but I should have chosen a 22 strike price because the call premium wasn't so bad either at 22. So this is a mistake I made, but I'm learning from it. I got greedy and I chose the wrong strike price, and now I'm going to pay for it, because right now my shares are going to get called away this Friday at 20.5, but I bought the stock at 21.81. So I'm going to lose money if they get called away. And for me to avoid them getting called away, I'm going to have to buy back the call option, which is trading at 2.7 right now. So I sold it at 1.38 and I have to buy back at 2.7. So that would be a loss. But I can sort of recover it, because I can buy back at 2.7 and then immediately sell the 23 strike price option at, let's say, 38 cents. So I pay 2.7, I collect 38 cents, and then my shares get taken away at 23 instead of 21.81. So if I do nothing, my shares will get called at 20.5, and I bought it at 21.81. So if I do nothing, I lose $1.30. If I buy back the option, I'd collect the difference between the original strike price and the new strike price. So 23 minus 20.5, so that's 2.5. So if I buy back the call option and then sell immediately at the same expiry date at a higher strike price, and my shares get called away because the stock is trading above 23, I'll collect 18 cents per share, which will get eaten up by the commissions. So I'd be in a better situation if I buy back the call option. Not going to make profit, but I'm going to lose less money. Or if I want, instead of letting my shares get called away, I can buy back the call option again, whatever it's trading at on Friday, and sell the next week or the next month call option at 23. For example, let's say I would sell the March 15 afterwards at 23, collect $1.20. So that could be another possibility, actually. So as you can see, it's more time consuming. It's more of a headache. It's more stressful because you have to take action. You have to watch it constantly in order to prepare. And of course, another example of missing upside is Micron that I bought at 33.8, sold the 36 strike price, collected I think $1 or something. Here, let's go check. So Micron, I collected 86 cents. Oh, sorry, that's Macy's. Micron, I collected $1, 99 cents. And look what the option is trading at. It's trading at 5.68. Of course, I'm not going to buy it back. So I collected 99 cents and I chose a 36 strike price and I bought the stock at 33.8. Right now it's trading at 41.52. So let's say I did not sell call options. So I'd be up 41.52 divided by 33.8, be up 22% in about 2 or 3 weeks. I think 2 weeks. But of course, I probably would not have kept Micron all that time. I probably would have sold it at 37 or 38. But now instead, I'm capped at a 9% gain in 30 days. So the 36 minus 33.8 plus the 99 cents that I collected. So 3.19 divided by 33.8, so 9%. So that's the downside of writing cover calls, is really missing out on capital gains. But it's not going to happen all the time. You're not always going to be picking winning stocks or stocks that are going to move up immediately. like Micron and Intel and Snapchat. So yeah, so this week or tomorrow actually, I have to decide whether I'm going to buy back the call option for United States Steel or just let it get called away at 20.5 and lose $1.30 per share. So United States Steel, so the first time I collected 125 and the second time I collected 138. So I collected 125 plus 138. If I just let my shares get called away, I'm going to lose 1.31, I believe. So it's like I just collected 132 from call options on a 2-month period on a 2181 investment. So 132 divided by 2181. So I'm not including fees here just to keep it simple. So it's like I collected 6% in 2 months, so 3% every month. But when I sold the call options originally, I was collecting 5% per month. So my 10% in 2 months dropped to 6% in 2 months if I let my shares get called away. And I could just see it as a lesson learned for picking the wrong strike price. If I buy it back, which I don't really want to buy it back because I'm going to spend a lot. I'm going to spend $270 just to buy it back. If I buy it back and then immediately sell the 23 strike price call option expiring the same date. So right now would be 38 cents. So I'd collect 38 cents. So I'm still down 2.32 per share, but I'll be at a higher strike price. I will no longer be at 20.5. And if my shares get called away automatically, then I make up the difference of 2.5. But if I don't let my shares get called away, what's the problem is with that is next week, for example, the stock can drop back to 21 or 20. So I would have paid this $2.70 for nothing. So for me to recover the 2.7 that I just paid, I need my shares to sell at 23 because that's the difference in the strike price. I'm basically paying the 2.7 to move up $2.50 in strike price. So come Friday, after selling after collecting the 38 cents from selling the $23 strike price call option, if the stock is trading, let's say at 23.23, I could either let the shares go or I can buy back the option at 23 cents because on Friday, if it's trading at 23.23, the call option here would be worth 23 cents about. So I could buy back at 23 and then sell the next month at $1.27. So let's say I would buy back at 23 cents and then sell at $1.27. So I'd be up $1.22. So if I do all these transactions, buy back, sell, buy back, and sell for 30 more days, then I'd be up $1.22 and I'd be at a higher strike price as well. So I mean that could be a possibility to get out of this scenario, is to buy back the option twice and then sell the call option at a higher strike price. In this case, I would keep my shares that I bought at 21.81 and I will have collected $1.25, $1.38, and $1.22. But this $1.22 includes the difference in the strike price that moved up. And that difference in the strike price, I'm only going to get if my shares get called away at that higher strike price. And that would happen only if the stock remains above 23. It's like I'm paying it up front. I'm paying $2.70 now, but I'm going to collect it when I decide to sell. So it depends on my patience if I want to wait month after month before selling or if I just want to sell it right away just to get out of the trade. So I think I'm going to have to decide tomorrow because the closer I get to Friday, the less beneficial this trade is going to be. I just want to share with you why covered calls are starting to piss me off and a few trades that didn't go so well for me. If you have any questions, leave them in the comments section below. Like always, if you're going to open an account with Questrade to trade on the stock market, use my referral code in the description below the video to get between $25 and $250 back. Also, check out the referral links in the description below the video to help support the channel. Thanks for watching.